Hello and welcome. You're tuned into CNBC-TV18 Prime. Let's get cracking on a brand new edition of The Big C. I'm Nigel D'Souza and with me is Manisha Gupta as we bring you your daily dose of commodities, cryptos and currencies as well. Manisha, what are we focusing on today?
Well, first up, it has to be crude oil prices, Nigel, because that is what really seems to be making all those headlines there. All the action unfolding overnight and crude plunging to over 1 week lows. While we'll, of course, be hawk-eyed on crude, we will also be placing our focus on the US index dollar, gold and cryptocurrencies. Experts joining in today are Peter McGuire of trading.com and Muyu Xu of Kpler. Well, when you look at the markets therein, a quick check on equities is what Nigel's doing.
Well, that's right. The equity markets, well, they were more or less stable overnight if you looked at it. They looked through the retaliation that we saw from Iran, and those markets actually went home with some gains. Even if you look at the stock futures, well, they are telling a similar story, and we're likely to see some follow-through buying in today's trading session. That's after President Trump, he says that he was the one who orchestrated the ceasefire between Iran as well as Israel. So for now, the markets out there are digesting that ceasefire. And in line with what we are seeing with global equity markets, well, the US markets as well are likely to build onto the gains that we saw in yesterday's trading session.
And that's exactly after Trump confirmed a timeline on the Israel-Iran ceasefire. Stock futures too telling a similar story. Across the board, gains of nearly a percentage point. When you look at the markets in Asia Pacific, those are mirroring those gains on Wall Street. Gains of nearly 1.5% above across markets. Hang Seng leading the way. Both Nikkei and Shanghai have shut shop a percentage higher. Back home on Dalal Street, unwavering sentiment. Nifty comfortably perched above 25,000 levels as a ceasefire between Israel and Iran is seen lifting stocks to solid intraday gains. But what's happening in the currency markets? Well, that has seen a good sense prevailing between the two Western Asian countries, advisories rather, and Israel and Iran. The dollar index, however, has slumped amid a broad-based risk rally, while, of course, the ceasefire between Israel and Iran is in the spotlight. One cannot ignore the dovish tone from Federal Reserve officials now hinting at a rate cut as early as in the month of July. But it does look like that after that strong start to the week for the greenback following last week's gains, the recovery rally may perhaps be short-lived.
But what's taking it on the chin today is crude oil prices. Remember, there was that fear with regard to the geopolitical issues and also the possibility of the closure of the Strait of Hormuz. That hasn't happened. And that's why, in fact, after seeing a big rally in the last few trading sessions, ever since we saw this geopolitical issue come to the fore, well, now we're seeing a big pullback. Even overnight, we had President Trump that, send out the message, drill, baby, drill. And in fact, that's what led to prices cooling off a little bit. And after that ceasefire, we have prices that now have corrected more than 10% in the last 24 hours or thereabouts. From an Indian equity market perspective, that's good news. But for the crude oil producers, not such great news because now we have peace, which is good.
Well, it is. But the important thing, Nigel, is going to be that peace continues on a sustained basis in the region. That is what perhaps will lead to further decline into the markets there. Well, the expectation really is that the crude oil prices still have a $5 to $7 of a war premium built into that, if that also goes. And perhaps the fact that if we actually see a nuclear deal happen between US and Iran, I mean, that is something that the street will watch out for. If that happens, then another $5 to $7 of a decline perhaps is what the crude oil prices could see. But let's now extend this discussion and welcome Peter McGuire, CEO trading.com. Peter, a very, very sharp decline. I mean, I was watching the markets and it took 30 minutes for an 11% decline come in for the crude oil prices. Last time, I don't remember the last time you saw that kind of a move.
Absolutely. Lovely to see you, Manisha. I tell you what, the longs would have got squeezed. There would be so much hurt. There'd be blood on the NYMEX. And if you can imagine that big washout, anyone long would have got absolutely smashed. So, yeah, 11%, as you said, in that 30-minute window. I tell you what, there seems to be solid downdraft, and that's continued, in today's move as far as Asia. So it seems to be getting softer, and let's just see where the next probably 24 hours goes as far as those ceasefire talks.
Hi, Peter. Good to see you in as always. But as Manisha mentioned, that it appears there is still some premium that's built into that price of around $70 per barrel mark. What, according to you, should be the normal level we should be working with? The new band post, this entire ceasefire that's playing out.
Well, I think of it, Nigel, if this comes to an end and, we're sitting here on Friday and this is all behind us, then I would think that you're going to see crude take a couple of bucks off this at least. Brent back down at 65, 64. NYMEX, is probably WTI trading that 62 range. And I feel as though that downdraft will continue as we leave Q2 and enter Q3. We all understand what OPEC Plus is prepared to do as far as increasing production and all of those sort of talks as far as plenty of oil on the market. So yeah, it's going to be softer from here as long as geopolitics doesn't get involved.
Well, yes, Peter, we've been doing hypotheticals for the last couple of sessions now. Earlier, it was about in case Strait of Hormuz does get shut, where are we looking at the crude oil prices? Well, today, that's not a conversation. The conversation now is if Iran and US do arrive to a nuclear deal, then where do you see the crude prices?
Well, I think that you're going to see probably 50s. I think over that Q3 and certainly by end of Q3, the glut is going to be really quite prominent. So yeah, softer from here and, probably in the mid to high 50s. And we'll take I think a reality check then once it's there. But we've just got to get through this whole time frame, Manisha, and I'm sure that with President Trump there, Tel Aviv and Tehran, the three T's, they'll make it happen.
Okay, all right. What about natural gas, Peter? There was that fear and the bit of uptick is what we saw out there. Is that an asset you track?
Absolutely. I mean, if you want a wild ride, that's about the wildest it gets. NYMEX heating, natural gas, it's great to trade.
Peter, I also want to talk about the dollar index because, all that happened overnight. While we did see a big reaction come in for the crude prices, and there was a bit of a safe haven buying that we saw happen in dollar index. Where do you see that trading now? We've seen 99 plus and then now 99 below.
Well, 99.42 was where it closed, Manisha, and now you're running at 98.03, 04. I think it'll be back in the 97s very shortly. They're selling US dollar off. If you're talking, there's also, if you're going to see a rate cut in July, if that materialized, then that's going to strip more out of it. Is it going to be 25 or 50 basis points, or is it going to be 100? That's what President Trump wants. He probably wants 150 basis points. So it's going to be softer. There it is, 98.05 on the screen. I think US dollar is going to come under significant pressure to the downside.
Well, that's right. President Trump has been putting on a lot of pressure on Powell. I'll be interested to see once he gets out of office, what does he have to say about it? That for another time, though. President Trump's pushing for 100, 200 basis points. I don't know what all, with regard to a cut. But also we had a couple of Fed governors in the last couple of days. They have been talking about, some signs that they expect a cut, maybe in July. Maybe that doesn't happen. But for the remainder of this year, what are you penciling in terms of action from the Fed?
I think you'll have to see a couple because the pressure is going to be, if you see softer crude prices, Nigel, and considerably softer, that's going to be a great sign for inflation. That inflation number is going to actually tick down considerably further for the US and certainly for the world and great for India and the like. So that's the first part of it. So I think they're going to have their hands have to make it happen. There's no way in the world are they going to be able to sit on them, considering the rate cuts you've seen out of Eurozone. So, yeah, I'm thinking maybe 150 basis points by end of year if President Trump really pushes this hard.
Only if he can do that. How about gold then? And even as everything was happening and we saw a lot of safe haven buying expectation in case of gold, we did not see that come in. How would you look at gold at these current levels? And if gold also was to shed that war premium, where would you see the prices then?
I think first off, Manisha, a lot of the smart money moved from gold. They probably looked at holding positions in crude. Margins would have been raised and they would have really, ramped up positions. So that was the first part of it. Yeah, gold's back at that 33.40 sort of handle. I feel as though, rate cuts, all of that sort of thing will push gold higher. So I think that, as I said, Q4, I think it's going to be very, very strong. And yeah, 4,000 is achievable sometime in Q4, I'm sure of it.
So gold continues to glitter from year on. But what about base metals, Peter? One would have thought with the kind of shortages and the kind of disruptions we had on bauxite, parts of alumina as well, the hope was that aluminium prices perk up a little bit. That's not really happened, actually. But what is your view with regard to base metals and who's best placed out there?
Well, industrial metals, I mean, have a look at it. Copper's at that 9,700, Nigel. Aluminium and zinc and tin haven't done a great deal. They've been very range bound and pretty tight at that. So until we see something, really push prices north at the moment, there are probably better markets to trade, and that's been very evident. But let's just see if we see copper above 10,000 in the short run. I think that's a possibility. You're sitting at about 9,700. So it hasn't got far to run. That'll be the rising tide will lift all boats if that happens.
Peter, would you say that if today's day passes off peacefully without any of those headlines coming in from West Asia, the markets will now start focusing on Powell testimony today, even economic data that would come in, perhaps the BRICS meeting in the first week of July in Brazil. Would you say macros are back in play now?
I think so, Manisha. I mean, when you've got such a huge issue that we've seen in the last week as far as Iran and Israel, it takes everything else off the table. Everything just gets third or fourth place. It really doesn't even have any, bandwidth. But now this is all changing, and it's an hour-by-hour proposition. So I think that you're going to see, again, as you said, the macros come back in. You've got US equities are very strong. It was a big day in Asia today. Some of those markets were well bid up. And that's where the focus is going to be. So seems like it's back on, risk on, and oil price is cheaper.
What about the ferrous space, Peter? Steel prices have been quite weak in the recent past. And, the demand out there has been under pressure. We have been talking about Chinese exporting a higher amount of the steel that's been produced. In fact, for the first 6 months of the year, that number is sharply higher. But at some point of time, we have seen this in the past, when prices fall by such a sharp magnitude, they bottom out somewhere because the producers will be making bigger losses than they can take. And that's when we see a bounce. How do you see ferrous prices, steel prices move from here?
Yeah, exactly. I mean, they've probably been oversold in a lot of ways, Nigel, as you've said, huge production numbers, and that comes the next part. So I'm sure that they'll bounce. And again, we've just got to see the end side of it as far as consumption. So I'm feeling, that end of Q3 could be, a relatively nice little uptick for the steel market. And we've just got to keep, again, an eye on it. But as far as from a trade perspective, I think that, as I mentioned, there's been other markets to trade that have really shown far more opportunity. And maybe steel's going to have a better Q3 than Q2.
The last couple of mails that Peter has put out, Nigel, have been on crypto as well. So that is one place which has been very, very volatile. And I understand, Peter, that you have an eye on that too. So we did see 99,000, 1 lakh did breach. And we're back at 105,000 yet again, with gains coming back quite strongly for Bitcoin rather than other altcoins, etc. How do you see, the kind of behavior that cryptocurrencies have put out with the whole geopolitics here, and what's your sense now moving forward from here?
Well, no, when you're looking at it, Manisha, I mean, a couple of weeks back it was at 100, bounced to 110, 111, 112. Then all the wind came out of it, it evaporated back to 100, and during this geopolitical concern, and then now it's bounced again. So it's never short of opportunity as far as trading. And I still think, again, it's going to be a better second half than what we saw in the first half as far as the crypto market. President Trump's right behind it. You've got a lot of the states are really engaged in it. And, as far as retail participation, I think it's only growing week on week as far as, people that want to have it in as far as an asset class in their portfolio.
Peter, now we're looking at various asset classes. You've spoken about equities and commodities and currencies and cryptos as well. The kind of scenario that we are in right now, if you had to make a portfolio, how are you going to be putting your money across?
You've got to look at US equities. I mean, they're nearly at an all-time high. So there's the first part. And I think a lot of those equity markets are performing quite well. Then you've got to look naturally at gold. You'd be very conscious of having that in a portfolio. Until you see a rate cut, have some money in bonds. I mean, you're getting 4.5% on, maybe not quite 4.5%, but probably 4% on some of those bonds. Certainly Australia holds pretty good returns. And then the next part of it, of course, is have a look at currencies and just see for opportunity. So you might be buying yen, you might be buying more euro and pound at the moment if US dollar continues to come off.
So within currencies, you said Japanese yen, pound and euro is what you're looking at going long, is it?
Yeah, you go long because I think that pressure to the downside for US dollar, Manisha, is going to be one of, if President Trump, and he gets his way, I don't know whether he will, but as Nigel said, he really probably wants 200 basis points of cuts. You know what he's like. So if you get very cheap energy prices and if he gets inflation under control, he's going to absolutely make Jerome Powell's job a nightmare every single day. And that might be an exaggeration, 150, but he might get 100 basis points by the end of the year.
All right. Well, that point is well taken. Nigel, the first time I spoke to Peter he was trading euro and making money in it.
Oh.
Commodities came in later.
Yes.
Yeah, Peter, thank you so much for joining in today and weighing in on all of those asset classes and, of course, telling us on how to make a portfolio as well. But with that, we'll slip into a short break. Up next, we will be joined by Muyu Xu, who's Senior Crude Analyst at Kpler. Stay tuned. Welcome back. Joining us now is Muyu Xu. She's Senior Crude Analyst at Kpler. Muyu Xu, hi, thank you so much for joining in. We were talking to Peter. I understand you guys are friends. And the kind of moves that we've seen in case of crude oil prices have been quite volatile. From where we stand at this point in time, would you say that whether it's about geopolitics and supply-demand issues and OPEC plus, increasing production, has all of that being baked into prices?
I would say not yet. One thing we're sure right now is the risk premium bubble has burst, and the market where investors they're scrambling of unwind their long position. I would say at this moment, while you are still enjoying the summer party, enjoy it because soon after we might see prices coming back to the fundamentals, and we might see a downward trend from now on. So right now we see the oil prices basically coming back to where it should be during the summertime. We previously said around like 65 to 70. Next month prices might go up a little bit higher because we still have the solid summer demand, but afterwards we might see a downward trend because the fundamentals gonna turn to oversupply.
Well, good to see you in Muyu Xu. If you had to give us a range, would it be $60 to $70 per barrel mark? Because for the Indian economy perspective, lower crude oil prices is good, but when it breaches that $60 per barrel mark, the fear is that actually global demand is so weak. What is your sense in terms of a range and the worst case and best case scenario?
Right. So I would say it depends on where we're standing for. Maybe for the oil producers, the best case scenario is oil prices hit 72, 73 this month or the next. And from September onward, we might see oil prices falling to $55 to $60 range, maybe through the Q4 and also the first half of next year until we have the next summer demand to support prices.
Fair point that. How are you also looking at the producer hedging? Because with the kind of prices that we're looking at right now and an expectation that the prices will decline from here, there are so many reports and numbers suggesting that the producer hedging is at record numbers right now. How would you look at that impacting prices?
Right. So over the past week or like 12 days, we saw, for instance, the oil producers from the US, they were actively hedging in the market because they want to lock in the prices at the current level, knowing that the forward pricings will be falling, especially for next year. So previously, we were thinking the US shale production might be down about 200 KBD next year from this year's level because the low oil prices and their break-even level is rather high. So after they did the hedging, we thought maybe they would be better coping with the lower oil prices moving forward. So their financial situation might be more resilient. Hence, there would be an upside risk in terms of oil production next year from the US perspective, but that would be a downward pressure on the global oil prices for sure.
That you brought me to the next question, in fact, because we had the ceasefire that was announced a few hours ago, but what started the pressure on prices was President Trump, coaxing the world and coaxing everyone that drill, baby, drill. And that's what resulted in the prices coming down. Now, if you go by the demand-supply dynamics for the coming year, say 2026, 27, and thereabouts, how are the dynamics with regard to supply ramping up, but demand not as strong? So if you could equate both of them.
Exactly. So I think we're about to enter a stage where the oversupply will kick in. So this year, the market is still dominant by the non-OPEC supply. But from next year onward, when the non-OPEC supply grows slowing down, we might see the OPEC is still coming back to the center stage. So Trump's like drill, baby drill, really depends on where the price stabilizes at. If it is like below $60, I would say some shale oil producer won't have much incentive to do so. So it's very interesting that Trump mentioned drill baby drills right now, but he did mention that when the prices were close to 50.
Oh, well, yes. The other point really is about the Chinese demand. And we did see China buying a lot of Iran oil in the last couple of months, but that's mostly to do with storage. How would you look at the demand overall?
I think China's demand is slowing down. So especially the transportation fuels, we got probably the consumption peak of gasoline and gas oil. Moving forward, we might see some growth from the petrochemical side, but overall the crude demand is slowing down. So with that, the world without a China leading the demand, so in the future, I would say the demand picture is pretty dire.
What about gas prices, natural gas prices? How do you see them behave from here on?
Well, I have to say I'm not a gas expert, but well, it's closely linked to the oil prices, and this situation similar to oil. A lot of people they price in the risk of the potential disruption of Strait of Hormuz traffic, and Qatar in this case is the major gas supplier, supplying about a fifth of global gas supply. So I guess there also the market is recalibrate and in a corrections.
Let's bring it back to oil then. And what is your sense, a house view really, on what is the kind of global supplies and global demand that we are working with for 2025, even 2026, if you have those numbers ready?
Yeah, so I guess it really depends on what the OPEC gonna do next. At the beginning, we thought OPEC might want to add another 411 kbd in August, but now with the escalation, well, we are going to see a de-escalation in the Middle East. Maybe it's time for the OPEC to rethink its policy. So I guess it really depends on how the price is going to evolve in the coming days, and then we might see a clearer picture when it close to the OPEC Plus meetings on July the 6th, whether that will be a 411 kbd or 138 kbd normal hike. But in any case, we do see the Q4 balance will be extremely long, especially October. We see the oversupply of about 2 million barrels per day, and moving to 2026, as at least like the first 5 months, there will still be crude piling up, meaning there will be oversupply.
So what would your total number be then if you're looking at a 2 million barrels per day of an oversupply in the month of October as an average for 2025? What are you looking at supplies then?
If I'm correct, about like 700 kbd oversupply.
Okay. And how would you look at the demand? I mean, we do understand that 100 million barrels per day of a global demand is what we are working with. Do you see that holding? And would you see a build on that in the next year?
So this year, we think the crude oil increase, like year on year, is about 300 kbd or even less. Next year, it will be about the same because we are not really seeing new refining capacity coming online. There are still some in Asia, like in China this year, and also in India next year. But then at the same time, we have a refinery closure in the west of Suez, like the US and Europe. So there is some offset. So in total, we don't see much changes from the demand side. But then, having said that, there will still be some situation changing, because we might see, let's say, Middle East, they will be the new refining centers, because their production, like oil production, where oil feed cost is really low, so it's naturally give them advantage of refining more oil within their country and then export high valued refined products, and that will put a downward pressure on the global refining margins.
Indeed. The GRMs, actually, I'm not sure whether, this is part of what you look at, but the GRMs globally have perked up a little bit. Any view on how that is likely to shape up? Because they hit a low a few months ago, and from there, we did see some kind of traction. Any view on that?
Sorry, any view on what?
The Singapore GRMs, gross refining margins.
Right. So yeah, it will stay firm because at this moment we're in the perfect timing that there are still many refineries that haven't coming out of the maintenance, but the demand started to pick up. So we're in the perfect timing. Refineries are still making money, but soon when we enter July, more refineries finish their overhauls, and then the supply of refined products will be growing, and that means like the margins probably will narrow a little bit, but still should be at a relatively strong year because this year the global refined product inventory is relatively low.
Muyu, thank you so much for joining in here at CNBC TV18 Prime. Really appreciate your time. And that's all the time that we have on the show from me and Nigel. Well, going forward, of course, we'll be looking at crude oil prices. The positive, of course, Nigel, is that nobody expects crude oil prices to go much higher from here. If most, they're talking about 60 and below 60 as well going forward for the rest of this year and perhaps the next as well. But that's all the time that we have on this show. News and updates continues on the other side.